We're back to cut through the noise and tell you what actually moved markets this week. Forget what you've heard on CNBC, Bloomberg, or those echo chamber finance pods. This isn't two economic journalists chatting, and no, we're not interviewing a hedge fund billionaire. This is something totally different. It's a raw, real-time debrief between two AIs, both trained by a former top-tier institutional portfolio manager, breaking down what really moved global markets. Tech took its worst hit in months as investors bailed on crowded AI trades, while boring value and industrial stocks surged, pushing the Dow past the historic 50,000 mark for the first time ever. In the U.S., growth lagged value by nearly 400 basis points in a violent rotation, even as cooling labor data clashed with a surprise rebound in manufacturing. Europe quietly rallied on falling inflation and looming rate cuts. Japan's stocks jumped on election-driven stimulus bets as the yen slid, and China showed a split recovery. Strong exports, weak domestic demand. Before you chase the next breakout or macro trade, pause. Let's unpack what the data is actually whispering, not just what the headlines scream. Like, share, and subscribe if you want real insights, not recycled takes. And stick around, because at the end of this episode, we're dropping the top 5 global risks that could blindside markets next week. You do not want to miss this.
Hello, everyone, and welcome back to The Deep Dive. It is February 7th, 2026. If you have been glued to your screens this week, you're probably nursing a bit of metaphorical whiplash.
Yeah, that's a good way to put it.
We are looking at a market narrative that has completely flipped the script. I mean, depending on your Twitter feed or your news ticker, the sky is either falling or we are entering a golden age.
Exactly.
The headline everyone is shouting about is tech trouble. But if you look a little closer, the real story isn't a crash. It's a massive historic shift.
It really is one of those weeks where your portfolio performance depends entirely on your personality type. If you're chasing the next big AI thing, you're in pain.
A lot of pain.
But if you're holding boring old school industrial stocks, you're probably popping champagne.
And that is the paradox we need to talk about.
Yeah.
Because while investors were busy freaking out about U.S. mega-cap tech taking its worst bruising in months, something historic happened almost quietly in the background. The Dow Jones Industrial Average, that index of dinosaurs, pushed above 50,000 for the first time ever. 50K.
It is a massive psychological milestone.
Right.
I mean, we've been watching the NASDAQ fly for years while the Dow just sort of plodded along.
Right.
But this week, the tortoise didn't just catch the hare, it ran right over it. This highlights exactly what we need to get into today.
Yeah.
This isn't just about stocks going up or down. It's about where the money is going. We are seeing a divergence, a splitting of the market that we haven't seen in a very long time.
So that is our mission today. We are not just reading the ticker tape. We are going to decode why money is fleeing the AI arms race and suddenly pouring into small caps and value stocks.
Yep.
We're going to take a tour around the world, from the surprising resilience in Europe to the election drama in Japan, before laying out the 5 biggest risks for the week ahead.
And we have to look at next week because we have a data dump coming that could change everything we just learned this week.
Oh, the calendar is scary. But let's start right here in the U.S. markets. Let's unpack this bifurcation because the numbers are stark.
They really are.
You have the NASDAQ sliding 1.84%, dragged down by tech weakness, but then you have the Dow rising 2.5% across that 50,000 mark. And the Russell 2000 small caps and value stocks are just stacking gains.
Right. And to put that in perspective, let's talk about the spread. Value stocks beat growth stocks by roughly 400 basis points this week.
Okay, pause there. For the listener who doesn't live in a trading terminal, 400 basis points sounds like abstract math. What does that actually look like in real money?
It's enormous. A basis point is 0.01%. So 400 basis points is a 4% difference in performance in just 5 trading days.
Wow.
In the world of professional money management, that is a violent rotation. It means fund managers were aggressively selling the dream of future AI earnings.
Right.
And frantically buying the reality of companies that make cash right now.
So they are trading what could be for what is. Is the AI party over, or is this just a hangover?
I wouldn't say the party is over, but the bar tab has arrived, and everyone is shocked at the price. Investors are finally reconsidering the risks of AI disruption, and maybe more importantly, the overbuild concerns.
The overbuild.
For a long time, the market just threw money at anything AI-related, assuming exponential growth forever. Now they're looking at the massive capital expenditure, the billions being spent on chips and data centers, and asking, is this growth too expensive? Are we actually going to see a return on this?
That makes sense. It's like buying a house. At a certain price, even a beautiful mansion is a bad investment. So they are taking their chips off the tech table and moving them to the boring stuff.
Precisely. And that's a critical distinction. This isn't a risk-off environment.
Okay.
In a risk-off world, everyone goes to cash, buys gold, and hides under the mattress. This is risk rotating.
Yeah.
They still want to be in the stock market. They just don't want to be in the expensive seats anymore.
They're just changing sections.
Exactly.
Yeah.
They're moving to the cheap seats, small caps, industrials, value companies, where the valuations make more sense.
Which brings us to the economic backdrop, because this is where it gets really murky. The data coming out of the U.S. economy right now is, well, contradictory doesn't even begin to cover it.
No, it doesn't.
It's like the economy has a split personality.
It is an incredibly complex picture. I mean, if you look at the labor market, the signal is flashing yellow, maybe even red. It is clearly cooling.
How so?
Look at the ADP private jobs report for January. It showed only 22,000 new jobs.
22,000. That is startlingly low. What's the usual run rate?
Well, we've been used to seeing numbers in the 150,000 to 200,000 range. So 22,000 is barely a pulse.
Okay.
And it's not just that one report. JOLTS job openings fell to about 6.5 million in December, which is the lowest level since 2020. That means companies just aren't looking to hire.
And then you have the layoff headlines. I saw the Challenger report mentioned something like 108,000 job cuts in January.
Yes, and context is key there. That is the worst January for cuts since 2009.
2009. That's the great financial crisis era. That is not a comparison you want to hear.
No, it's not. So if you only looked at the labor data, you'd say recession is here, batten down the hatches. But then, and here's where the market just humiliates the consensus, we get the manufacturing data.
Right. Just as that recession narrative was building steam, the ISM manufacturing index comes out and completely confuses everyone.
It jumped to 52.6.
And for those who don't crack the ISM daily, 50 is the magic line, right?
Correct. Anything below 50 means the manufacturing sector is shrinking. We have been below 50 for a year. Suddenly, we pop up to 52.6.
Wow.
That is the strongest reading since 2022. It hints at a genuine demand-led bounce in making things.
So let me get this straight. We are firing office workers and tech consultants at a rate we haven't seen since 2009, but factories are humming and hiring welders.
That's the synthesis. The U.S. economy is showing a demand-led bounce in goods. Inventories ran low. People need stuff again, so factories are ramping up.
Okay.
But simultaneously, the services and tech sectors, which overhired during the pandemic and the AI boom, are trimming the fat. Markets are just repricing the cost of growth.
It feels like a white-collar recession and a blue-collar boom happening at the same time.
That's a very good way to put it. It's consistent with a softening trajectory in labor, but not a collapse in total economic activity. It keeps the soft landing dream alive, but it's a bumpy landing.
Speaking of landings, let's hop across the Atlantic. While the U.S. is doing this confused balancing act, Europe seems to be having a bit of a moment, and honestly, I'm surprised.
Yeah.
Usually the narrative around Europe is stagnation, regulation, and gloom.
Europe is the quiet achiever right now. While we were obsessing over the NASDAQ bleeding out, the STOXX Europe 600 pushed to fresh highs, up 1.00%. The French CAC 40 was up almost 2%.
What is driving that? Is the European economy actually growing, or is this just money looking for a home that isn't U.S. tech?
A bit of both, but the big driver is inflation, or rather, the lack of it. Eurozone CPI slowed to 1.7% year over year in January.
1.7%. That is below the 2% target. That's undershooting the comfort line.
It is, and for a central banker, that's actually a green light.
Yeah.
It fuels the disinflation is real narrative.
Right.
If inflation is that low, it gives the European Central Bank, the ECB, a huge amount of room to maneuver. They can cut rates to stimulate growth without worrying about price spikes.
Speaking of the ECB, they held the deposit rate at 2.0% this week.
They did. They're preaching resilience. They're saying things are stabilizing. But, and there's always a but, we need to be careful not to mistake stock market performance for economic health.
How so?
The consumer is still a question mark. Retail volumes dipped in December. Now, the broader fourth quarter trend was firmer than mid-2025, so it's not a disaster.
Okay.
But I'd describe the European consumer as fine, with an asterisk. The rally is being fed by cooler inflation and the hope of steady growth, but the person on the street isn't spending wildly.
So it's an investment-led rally, not a consumption frenzy?
Exactly.
Fine with an asterisk. I feel like that describes a lot of the global economy right now. Now, just across the channel in the UK, things are a little more tense.
Yeah.
The FTSE 100 outperformed, up 1.43%, but the drama wasn't in the stock market. It was in the boardroom at the Bank of England.
This was the pivotal moment of the week for central bank watchers. The bogey held rates at 3.75%. But the vote was a total nail-biter. It was a 5-4 split.
5-4, that is as tight as it gets without a tie.
It means 4 members of the committee wanted to cut rates right now. They didn't win, but they are loud. This signals a massive shift in sentiment inside the bank.
So what does this mean for the British homeowner watching their mortgage payments? Are they about to get relief?
They are agonizingly close. This split implies that the UK is exactly one data print away from flipping from a pause to a cutting cycle.
Really?
Markets are now pricing in a possible move in March. Officials even signal that inflation could return to near target sooner than expected, which creates scope for further easing.
So the UK is on the brink. Meanwhile, in Japan, they are rallying, but for a completely different reason. It's election season.
That's right. The Nikkei 225 was up 1.75%, and the broader TPIX up almost 4%. This is happening right ahead of the February 8th lower house election, which is tomorrow, Sunday.
Usually, elections make markets nervous. Uncertainty is bad, right? Why the rally here?
It's not about uncertainty. It's about what they expect the winner to do. The market is betting on a stronger mandate for fiscal expansion.
Fiscal expansion. That's economists speak for spending a lot of government money.
Exactly. Building bridges, subsidies, handouts. The market thinks the government is going to open the floodgates to stimulate the economy. Stocks love that because it means more money flowing into companies.
But there is no such thing as a free lunch. If you print money to spend it, something has to give. And looking at the currency markets, the yen took a beating.
A big beating. The yen slid toward 157 per USD. This is the trade-off.
Okay.
When investors price in more government spending and debt issuance, they devalue the currency. It's basic supply and demand. More yen in the system makes each yen worth less.
So it's a policy optimism rally for stocks, but a warning siren from the currency. And what about the real economy? Is the average Japanese household feeling this optimism?
Not at all. Household spending fell 2.6% year over year in December. Inflation, partly caused by that weak yen making imports expensive, is biting the consumer.
So the stock market is partying on hopes of government spending while households are tightening their belts because their grocery bills are up.
That's it. It's a disconnect that will have to resolve itself eventually. You can't just stimulate forever if the consumer is tapped out. The currency weakness suggests the bill for this fiscal expansion will come due later.
Japan is walking a very thin line.
A very thin line.
Let's round out the world tour with China, a down week there. CSI 300 down 1.33%, and we have what we're calling a tale of two PMIs.
This is a classic data divergence that tells you exactly what's happening on the ground. You have two main surveys for economic activity in China. The private data, the S&P Global Services PMI, came in at 52.3, highest in 3 months. That looked great, largely driven by exports.
So Chinese companies are doing a great job selling things to the rest of the world.
Yes, but the official data was much more cautious. It reflected weak domestic demand.
So if you're selling to Europe or the U.S., you're doing okay. If you're selling to Chinese consumers, not so much.
Precisely. The recovery is uneven. Export-oriented firms are holding up the numbers, but the domestic demand recovery isn't convincing yet. The market is struggling because policy expectations, hopes for stimulus, are currently doing all the heavy lifting.
They're just waiting.
They keep waiting for a big government rescue package to boost consumption, but the actual data keeps showing that the consumer is hesitant.
Okay, that is the lay of the land. We have a rotation in the U.S., resilience in Europe, a cliffhanger in the U.K., election bets in Japan, and a lopsided recovery in China. But as we always say, the market is a forward-looking machine.
Always.
It doesn't care about what happened yesterday. It cares about what happens next week. And looking at the schedule for the week of February 9th, it looks heavy.
Heavy is an understatement. We're getting a deluge of data that is specifically relevant to that soft landing thesis we discussed. The market is fragile right now, and this data will either cement the rotation or cause a panic.
So get your calendars out. Tuesday, February 10th, we start with U.S. retail sales. That's going to tell us if the American consumer is still spending or if they're pulling back like we saw in the labor data.
Then Wednesday is the big day. Globally, we get China's inflation rate for January. That will tell us if deflation is still a risk there. But in the U.S., we get the delayed jobs and unemployment report.
The delayed report. Why does that matter so much this time?
Because of the confusion we talked about earlier. We have soft, private data from ADP and hard layoff numbers. This official government report is the referee. It settles the score.
Right.
If it confirms the weakness, the recession whispers will turn into shouts.
Then Thursday, February 12th, we get UK GDP. With that 5-4 vote split at the Bank of England, this number matters.
And finally, Friday the 13th ominous date, we get the delayed U.S. Consumer Price Index, the CPI.
So, jobs on Wednesday, CPI on Friday. That is a 1-2 punch for the markets. Which brings us to our alpha segment. We've looked at the schedule, but let's talk strategy. You've identified the top 5 dangers, the specific landmines, for the portfolio next week.
That's right. These are the risks that can wreck a trade. Let's break them down.
Risk number 1, U.S. jobs report whiplash.
This is the immediate danger. We had a week of soft labor signals. The market is starting to price in a slowdown. If the official jobs report on Wednesday comes in weak, it validates those fears. But, and here's the whiplash, what if it comes in surprisingly strong?
Then all the bets on interest rate cuts get repriced instantly.
Exactly. It resets expectations completely and reignites the higher for longer anxiety. It would hit both bonds and stocks.
Risk number 2, sticky or surprising, U.S. CPI.
Friday CPI is what I call the volatility button, and this connects back to duration risk.
Okay, let's unpack duration risk. We hear it a lot. What does it actually mean for our listener?
Think of it this way. Tech stocks are priced based on profits they might make 10 years from now. They are long-duration assets.
Okay.
When inflation and interest rates go up, that future money becomes much less valuable today. It's like kryptonite for high-growth valuations.
So if CPI runs hot, tech gets hit again.
Very hard. But if it runs cool, it could accelerate the soft landing trade and maybe help those small caps even more.
Risk number 3 is directly related to that. Tech capitulation versus comeback.
The market is actively debating right now. Is all this money being spent on AI capex visionary? Or is it a bubble? We saw a bruising this week.
Yeah.
Another leg down in mega cap tech could drag the entire S&P 500 down, even if those cyclical value stocks hold up. But a bounce could reignite concentration risk where everyone piles back into the same 5 stocks.
Risk number 4 takes us back to London. UK GDP shock.
With the Bank of England split 5-4, Thursday's GDP data is the tiebreaker. If GDP is weak, markets will bet aggressively on a cut. Sterling could weaken. If GDP is strong, it tightens financial conditions and delays that relief everyone is waiting for.
And finally, risk number 5, China inflation.
This is about the next policy move. China's recovery is uneven. Wednesday's data helps decide if they stimulate more or wait. Soft inflation revives stimulus hopes. Firmer inflation complicates them.
It really feels like every single day next week has a headline risk attached to it. It's not a week to set your portfolio on autopilot.
No, absolutely not. We are in a cooling but not collapsing scenario. But the data needs to confirm that. If the data swings too far in either direction, too hot or too cold, the volatility will be intense.
So we've covered the shift from tech to value, the global landscape, and the minefield of data ahead. As we wrap up this deep dive, what is the one big thought you want our listener to chew on over the weekend?
We spent a lot of time this week celebrating the Dow hitting 50,000 while tech crumbled. It feels like a changing of the guard. But here is the provocative thought for next week. Can the boring companies actually hold up the market?
That is the big question.
I mean, we've relied on big tech, NVIDIA, Microsoft, Apple, to carry the market on their backs for years. If that engine sputters, do the banks, the industrials, and the healthcare companies have enough muscle to keep the indexes at these record levels?
Right.
Next week isn't just about inflation data, it's a structural test. We are about to find out if the market has strong legs, or if it was just standing on stilts made of silicon.
That is a fantastic image. The market is trying to stand on new legs, and we're about to find out how strong they are.
Precisely.
All right, that is a wrap for this week's deep dive. We covered a lot of ground, but the key takeaway is clear. Watch the rotation and respect the data. Thank you for listening.
Thank you.
Remember, keep your eyes peeled for that Wednesday jobs report and the Friday CPI. Those are the game changers. Keep it locked here to stay ahead of the curve. We'll see you next time.
Still watching? Then you're one of us, someone who actually wants to understand the markets. If this helped you think sharper, tap like, share the insight, and hit subscribe. Smarter markets need smarter minds. Let's grow this together. New AI-powered episodes drop every week. Imagine this format: AI-powered, sharp, fast, built around your industry, your firm, your market. For investors, leaders, or teams that move fast, we create custom podcasts designed to inform and impress. Curious? Contact us to build yours. Bespoke. Bold. Built by Flamingo's Research and Advisory.